Hello guys, it's been ages since we had a lesson. That's why I decided to record a video lesson. You can refer to pages from 244 to 247 on your book Best Performance. So let's start discussing what is a stock exchange. A stock exchange is a regulated financial market where securities are bought and sold. What is a share? A share is one of the units that the ownership of a company, a fund, or whatever is divided into, and which can be bought by the members of the public. You already know the difference between a share and bonds. Bond is an agreement. When a government or company issues a bond, it borrows money from the investors. But which are the main functions of a stock exchange? Let's see. In the primary market, a company can raise capital by selling shares, usually through an IPO, an initial public offering. In the previous previous semester, we studied other forms of raising capital, like, for example, we discussed types of mergers and acquisitions, if you remember. In the secondary market, the stock exchange has the function of an intermediary between those wishing to sell and those wanting to buy shares. Nowadays, as far as we know, most stock exchange use completely or partially online and phone trading, which can be carried out only by members. But what is a bear and a bull market? We know that share prices can naturally go up and down in relation to market forces of supply and demand, or depending on other factors like, for example, positive or negative company reports and forecasts or political historical events. Let's think about the Brexit nowadays, which, as we know, had negative impacts on the market. What is the purpose of trading on the stock exchange? For sure is making a profit by buying low and selling high. When we say bull market, we mean that there is confidence in the market and share prices are generally rising. Instead, on the contrary, a bear market is when prices are predicted to fall. Now let's discuss what is a commodities exchange, also known as a futures exchange. A future exchange is where commodities and derivatives are traded. Commodities are a substance or product that can be traded in large quantities, like, for example, oil, metals, grain, and coffee. Derivatives instead are financial products whose value is based on that of another asset. A futures exchange is an intermediary. A futures exchange acts as an intermediary in the trade of futures contracts. Future contracts are agreements to buy or sell a certain quantity of a commodity at a predetermined price and date in order to fix the best possible rate, that's for the seller, and to avoid price increases, and that is for the buyer. What is an index instead? An index is an indicator of trends on the stock exchange. It provides a quick picture of what is happening on the market. When an index goes up, there are more people buying than selling, and share prices have risen. When it goes down, people are dumping shares. Famous indices are Dow Jones, which is based on the 30 blue chip companies quoted on the New York Stock Exchange. Another famous one is the Financial Times Stock Exchange 100, also known as FTSE, measuring the share price performance of the 100 largest traded companies on the London Stock Exchange. The Nasdaq 100 includes more than 100 of the largest domestic and international non-financial securities listed on the Nasdaq stock market in New York. What is spread? When you listen to the word spread, you know that it means the difference between two prices or interest rates. In the stock market, a spread is a gap between current bid, that is an offer to buy something at a stated price, and the ask price of a share or other security. What is a bond spread? The bond spread is the gap between yields of comparable bonds. The bond spread is intended to gauge the performance of a company of government bond. Its yields is compared to that of a benchmark bond with less or no risk of default, like for example the US Treasury bonds. So what happened? The wider is the spread between the two bonds, the higher is the risk for the investor. You know that brokers are intermediaries. They are authorized intermediaries trading on behalf of a customer on a stock exchange. They can be part of a bank or brokerage firm, offering also online trading for small and private investors. They receive specific training and they earn money through commissions on each transactions. They can be execution only, advisory, or discretionary. The execution only carry out clients' instructions to buy or sell shares without giving any advice. The advisory ones provide advice on current trends, analysis of shares and companies, and execute clients' orders. The discretionary ones are the ones earning more money and applying higher commissions on transactions because they buy and sell shares according to clients' instructions, but they are also authorized to make investment decisions. The London Stock Exchange and the New York Stock Exchanges are the most famous one. The London Stock Exchange dates back to 1801. Originally, brokers would meet in a coffee house to discuss investments and trade in shares. Then a list of the prices of shares and commodities was created, and finally a club of brokers was formed in 1801. The New York Stock Exchange instead is the oldest and largest in the USA, located in Wall Street. The origins go back to 1792, when 24 brokers met under a tree in Wall Street and signed an agreement establishing rules for buying and selling companies' shares. One of the few stock exchanges operating using the traditional open outcry system. Actually, this system is characterized by brokers who meet face-to-face on the trading floor in addition to electronic trading. Originally, the New York Stock Exchange was a membership-only organization. In 2006, it became public. What is the Big Bang when we talk about finance? The Big Bang refers to a change in the stock exchange's structure and operations. In particular, the exchange became a private limited company. It was introduced as screen-based electronic trading. All firms could operate as broker-dealers, trading on behalf of clients. Let's close our lesson with further concepts. So, first of all, what do we mean by insider trading? When a person makes a trade on the stock exchange based on the knowledge of information that can positively or negatively affect the price of a company's shares, it means that there is an unfair advantage. And so we talk about insider trading. But what do we mean by short and distort or pump and dump? These are also legal actions in the stock exchange, and they refer to traders trying to make a profit by manipulating share prices to their advantage. This can happen through false information about a company, which is given to damage the company's reputation. This false information can be in order to exaggerate the company's performance or to simply ruin the reputation of a company. What do we mean by speculation? When a trader has a high-risk investment strategy aimed at making quick and substantial profits. What is an economic bubble? When prices of shares or other securities continue to rise extremely sharply until there is a sudden collapse and the bubble bursts. In this case, huge losses for investors happen. That's the end of the presentation. I will upload the presentation on Classroom, and for any questions you can ask and write comment, post comment on Classroom. So let's update next lessons, guys. See you. Bye bye.